Hi, everyone. And thank you for that kind introduction, David. I'm honored and delighted to be here this afternoon to close out a truly amazing event. As portfolio managers, our goal is to add alpha. We all have our own philosophies and processes that we believe do that on behalf of our clients. But in aggregate, as an industry, we don't have a great track record of late. The last time the majority of active managers outperformed the S&P 500 was in 2009, 12 years ago. In fact, in only 3 of the last 11 years was that percentage greater than 1/3. In other words, in 8 of the past 11 years, fewer than 33% of active managers outperformed the S&P. Now, we can all rattle off a number of factors that likely contributed to this period of underperformance. Number 1 on that list for most of us is the titanic shift from active management to passive. Passive assets now represent over 50% of assets under management in our industry, up from less than 5% in 1995. I often ask myself if the typical relatively conservative retail investor who's looking for a diversified portfolio and buys an S&P fund understands that he or she is allocating about 25% of his or her assets to just 6 companies: Apple, Microsoft, Google, Amazon, Facebook, and Tesla. My guess is that they don't. So how did we get here? In part, it is thanks to the research finding of an economist, Hendrik Bessembinder, who some call the father of passive investing. I'm sure many of you are familiar with Bessembinder's work, but for those of you who are not, I'll briefly recap. Bessembinder found that since 1926, 4 out of every 7 common stocks, that's more than half for everybody who's doing the math, have appeared in the CRSP database of listed US stocks have had a lifetime buy and hold return below the 1-month Treasury return. So 4 out of every 7 stocks did worse than 1-month T-bills. He also found that when equity market returns are stated in terms of lifetime dollar wealth creation, the best performing 4% of listed companies account for the entire net return of equities over Treasury bills. So more recently, that number was just put at 2.4%, not just 4%. So a very small number of companies generate all of the outsized return of equities over bills for the past 90 years, 85 years. Bessembinder's conclusion was that nobody was talented enough to identify this small subset of companies. Therefore, investors were best served by giving up on active managers and investing in the index. Now, we disagree with Bessembinder's conclusions. So we put the majority of our research efforts, as David said, into finding companies that are among the very small percentage of companies that drive the stock market's long-term outperformance versus bonds. We're looking for the undiscovered disruptors, innovators, trailblazers that change how we do things, and most importantly, make money by doing it. So I'd be happy to discuss our processes and investment philosophy and themes offline or through Q&A if anyone's interested, but that's not why I'm here today. The focus of this panel, and indeed most of Alpine's really excellent research, is on the ever-evolving, ever-changing global macro landscape. So why is a long-term thematic investor who is predominantly focused on secular changes the moderator of this panel? That's a good question, Dave. No, I'm just kidding. But the answer is that not even the most focused or concentrated long-term investment manager can afford to ignore the environment in which we put money to work. At the start of every year, for as long as I can remember, sell-siders across Wall Street proclaim, this is the year that it's a stock picker's market, right? How many of us hear that every January? Macro doesn't matter. This year, it's just stock picking. Just find those companies. But I can't think of a year in the past decade where that's been true. Macroeconomic factors have been driving market returns to an increasing degree. Today, as we all know, market fluctuations are more correlated with movements in the US 10-year Treasury bond yield than ever before. The 20% of stocks that do best when interest rates fall, the growth stocks, mainly from the tech sector, are trading at a record 70% PE premium to the market. While the 20% that do best when rates rise, mostly value stocks in the financial and commodity sectors, are trading at a record 40% discount. So we make macroeconomic analysis an explicit part of our thematic investment process at Chevy Chase Trust. We use it to properly weight the disparate themes in our portfolio, some of which are more closely aligned with value factors and some which are more correlated with growth factors. Some of our themes have more exposure to the US economy, while others are more tilted to international markets. Fortunately, knock wood, over long periods of time, almost all of our themes have added alpha for our clients, but they don't all work at the same time. So proper weightings at any given time is the key to delivering short-term outperformance. But even a crystal clear understanding of the macroeconomic landscape is not enough. We must understand what the landscape means for markets. Will good news on the economy, such as a strong jobs number or a PMI number, be a positive for stocks because investors will raise earnings estimates? Or will it be negative for stocks because it will accelerate the timeline that the Fed is going to taper or tighten? We not only need to know what's likely to unfold, but we also need to know what that means for markets. So these gentlemen are here to tell us, which is great. No pressure. But so I'm going to start with a couple of questions, and then I will take questions from the audience online and in the room. But I'm going to start with a layup. This one's really easy, guys, okay? So this one's on valuation. So, everybody's been talking about valuation today. The NASDAQ trading at 32 times earnings. One word answer. What's more important, relative valuation or absolute valuation?
That's a good question. The answer is probably have to take into consideration of where bond yields are today. Lots of people showing the charts, PE ratio, price to book today versus late 90s were probably comparable level. The only difference is that back then we're talking about bond yields at about 5%. Today is 1.5%, call that plus minus. So that is first thing you have to take into consideration. But you don't want to over extrapolate that too, because if you think about Japan's situation where bond yields actually can fall to zero, does that mean that equity valuation should go to infinity?
Right.
Nonsense. Right. So there is a kink point. It's always, in Japan's case, the kink point kicked in when bond yields about 2%, meaning the correlation started to shift. Prior to that, you basically have higher valuation stocks, lower bond yields, but at about 2%, the whole correlation completely shifted. If you look at Japan, when the bond yields drop below 2, the equity valuation basically stuck at about 13 times.
Right.
Stopped falling. So it basically makes sense, because if bond yields drop to below 2 or even approaching 0, it basically tells you your nominal GDP growth is going to be problematic.
Right.
And you can't have a phenomenal equity valuation because the revenue, profit growth has become problematic. So I think we're going too far, but we're talking about the United States. My gut feel is I haven't spoken with my colleague. I'm just pat my head with just saying, what the hell? I'll just give you my speculation. My feeling is that the Fed probably want to raise rate, but I don't think they can. Right. Weird stuff when you think about it. Every financial crisis pushes one region into permanent zero.
Right.
The GFC.
Right, we did Japan, then Europe.
And then the Asian crisis drove Japan into zero. GFC drove Europe into zero. I think this pandemic probably be the one that actually drive the U.S. to permanent zero.
But the valuations in Japan and Europe have also came down when the rates came down.
Exactly.
And we haven't seen that in the U.S.
That's why I think you don't want to be too confident to saying that this valuation really okay. I often hear people saying that because bond yields are very low. So what's the
That's the
problem?
rationale
Well, the
every
problem
equity
is if
bull
you got
gives.
into, exactly, the problem is that if you got into permanent zero, there would be a reason for that, and the reason for that is not going to be very bullish for
Right.
equities.
You're not going to get 10% earnings growth in that
Exactly.
macro environment.
That's my speculation.
Right.
I just wanted to
Yep.
add, as long as inflation expectations are anchored, what Chen said, it sits very well with me. It makes a lot of sense, and he's written about Germany and Switzerland and Japan and the PEs. They just kind of sit. Once interest rates are anchored, you can't get a lot of nominal earnings growth.
Right.
But if inflation becomes unanchored, I think all bets are off because an index like the S&P 500 has become so sensitive. A chunk of it has become so sensitive to bond yields, it's very hard to tell how much the S&P could go down if bond yields look like they may go to 4 or 5%, which was not a very high number 20 years ago.
So my question, I'll get back to this, but how can bond yields possibly go to 4 or 5%? Because if that happens, if even bond yields get to 2.5%, doesn't the equity market roll over? And isn't the equity market such a big part of our economy at this point that the reverberations, it used to be that the economy drives the equity market. It feels like of late, the equity market drives the economy. So if the equity market can't take those yields, it almost doesn't matter if housing can take those yields. So like if the real economy could take those yields. What's wrong with that argument?
I'm sure you'll all have a comment. Let me just very quickly say, countries that tend to have an inflation problem or even ultimately get into hyperinflation, they get into a vicious circle between the inflation dynamic, the balance of payments, and the currency. The capital goes out,
Right.
and all bets are off. That
Right.
happens in emerging markets on a regular basis. So if the supply side, let's just say, is just much worse in the US than we realize, we're all assuming these bottlenecks have a degree of temporariness to them, but if something is seriously wrong with the productive capacity of the US economy, and it's just something is just really badly wrong, it's very easy to generate inflation. You lose faith in the currency, and you get into a vicious circle where, yeah, it hurts the stock market, but that didn't help in Venezuela or Argentina.
Right.
I'm sure you guys have a lot to say.
I think lots of people talk about the 70s. Jim Grant talked about 70s. Tony wrote about it. I thought about it too, very hard. I come to the conclusion that actually the 70s inflation was the result of a major currency decline. Think about what happened back then. Basically, the U.S. dollar went off gold standard. It devalued about 90% against its own monetary standard. Don't look at the DX1 and everything else. Before 71, it was gold exchange standard. Your monetary standard is gold. And after the debacle, after we float the dollar, the thing basically dropped 90% against its own monetary standard. I think that basically caused repricing of everything.
Right.
And that lasts for a decade. I look at the U.S. fiscal balance during the 70s. It's not that bad. It's pretty good. I look at the U.S. current account balance. It's not that bad. It's pretty good. And I look at lots of other things. Of course, there was a union at the time. I think if you run a true free market capitalism, it's impossible to create sustained inflation. Why? Who's going to be paid more than his or her marginal output? Nobody. If anything, probably be paid a little bit less than your marginal output because capital owner get something. Only if you run a socialist society where everybody is going to be paid more than his or her marginal output is because nobody want to work, everybody want to make more money. That's where the inflation is. I personally don't I think 70s got a bit of that.
Right.
But mostly because of the currency decline.
Right.
And that explains a hyperinflation. Look at around the world. Every country got a currency collapse. They always have a hyperinflation.
Right.
Brazil, just to name a few countries.
But you don't see that happening in the U.S.
The dollar is too strong.
Right. Right.
That's why I think the surprise could be the inflation going to fall much faster than a lot of people believe.
So if inflation falls and interest rates stay low, where's the valuation disconnect? What brings the valuation in line? And I'll ask another question, or what brings us to a recession? What's, everybody says, if the Fed, don't fight the Fed, don't fight the tape, consumers
always,
in good shape, so what, if the Fed never can tighten and never can raise interest rates, and every time the market gets a little bit of a scare, a 5 to 10% pullback, whoever's Powell or whoever's chairman says, okay, I'm not going to do this now, what eventually breaks this cycle out of this?
My colleagues can speak up. I don't want to sort of dominate here because I'm just too talk active. But anyway, Harvard could say, Mark, bring up your opinion. But I think it's going to be policy mistake. It has always been policy mistake. Some people say, the policymakers want to bring up rates. I have no doubt in their mind they really want to have positive interest rates. But equilibrium, whether your equilibrium rate.
Right. What's your neutral rate? Right.
Exactly.
Right.
Exactly.
Right.
I think probably most likely it's negative.
You think it's negative?
Oh,
right.
yeah. So 2018,
Right.
they bump up rate to, correct me if I'm wrong, is 0.5%. The whole thing collapsed.
Right.
The market collapsed. The economy caved in. Then they backed away. That's
Right.
2008. At the time, equilibrium rate was about a 0.5.
Right.
They moved it from negative to 0.5. You tell me, after the pandemic, neutral rate is higher or lower? I'm pretty sure lower.
Right,
Yeah,
right.
so here we go, from 0 to some negative number.
So the Fed can never move, right? Are we all in agreement on that? Does anyone think the Fed's going to raise rates? And that's okay, going to be okay? Or are we just in
They're
violence?
going to try.
You think they're going to try, and
Oh,
that's going to be the
absolutely.
policy
They're gonna try
mistake?
down the road. That'll be the policy mistake because the Fed believes that the equilibrium interest rate, although is low right now, is going to rise in the future because of these headwinds that have been keeping the real rate low are dissipating.
Right.
And so they won't actually even couch it in terms of tightening. They'll say, look, the equilibrium rate is moving. We're just moving up with it.
Right.
But it's unobservable, the equilibrium rate, and our view is that it would end up be a mistake in the end.
Right,
But
so
they won't
play that
know-
forward. So then the market reacts negatively, and then does the Fed cut again? Do we get emergency stimulus again? All of the above.
All of the above, yeah. All those things are in the Fed's toolkit now, and they're a permanent part of the toolkit. Yeah.
And does the multiple react again? Or is that when we get our Japan-Europe moment?
Ultimately, if you have a pretty low, depending on your growth dynamics, I think, the fact that actually we may have zero rate for a long period of time is due to the fact that your nominal growth is going to be
Right.
too low.
Because you're,
When you have a nominal growth that has been too low, why in the hell people pay very high multiple for something that actually generate diminishing profit growth?
right.
So there's some disconnect right there. So I personally think that even though you have a zero rate, you're never get an infinity valuation. That's why I'm saying the kink point. If you look at the equity yield, earnings yield, versus bond yield, they always correlated together.
Right.
Until the bond yield dropped to a certain level, the other thing just
Right.
gone flat.
Right.
It's equity yield. It's the inverse of PE ratio, basically saying PE ratio rate increase, and then at certain point, PE ratio basically came down flat. Are we there? I think we're heading there, but we're not quite there yet. Probably we're one cycle away.
So when do you think we get there? When, or what?
Well, before
Give
I'm
me-
dead, probably.
Right.
I don't know, maybe next 5 years. Well,
Yeah,
one
it's
cycle
whenever
away.
the cycle ends,
Yeah.
when we get the next recession. But it's too soon for the cycle to end.
Right.
As Jim Paulson said at the beginning, the true unemployment rate is probably a 7 handle once you adjust for the labor force. The CAP-U rate is still in the 70s. There's too much excess capacity that needs to be absorbed before we can really talk about this cycle coming to an end.
Okay. So if Chen is right, and I'm going to read the question from the audience. If Chen is right and the U.S. cannot raise rates much, what is the future role of bonds in the typical balanced portfolio?
I think we've been not that bearish on bonds. We happen to be right. Now bond yields backed up, and I got a lot of letters, email from clients. What do you think? Should I buy? Should, what happened? What happened? What happened? I think, first thing first, bonds, equities, these two markets are self-limiting. So if the stock market dropped too much because of the bond yields backed up, then the bond yields
go down.
go
Right,
down.
right.
So I learned that from Harv because I think the bond, the term premium is very low. We understand that.
Right.
Extremely low. So it's really a terminal short rate that has a huge influence on long end of the curve.
Okay.
If the term
Right.
premium is extremely low. Now, you have to basically answer the question, what will be the equilibrium Fed fund rate?
Right.
As I said, right now, the equilibrium real rate probably is minus 1%.
Negative.
Just call that minus 1%, just
Okay,
easy to
yeah.
argue. And then the long end of the curve, if you back out inflation break even, is about a 2.2%, somewhere around there, right?
Yep.
So if, let's say in the future, the steady state inflation is about 2%, just
Right.
run up the number.
You get a 1%.
1% of yield
Right.
is not too far off. That's what I'm
Right.
saying. People saying, are you crazy? Think about bond yields at 1% being fair value. I can't see anything fair about it. I say, look,
Right.
this is the math, right? It's just a simple math. If we have steady state inflation of 2%, if we have equilibrium rate of minus 1%, bond yields, long end of the curve should be 1%. Of course, there are two ifs.
Right.
What if I'm wrong? Then we're
What if-
wrong.
right.
Lose money.
Well, what if you're wrong and inflation is not 2.2%, but 3.2%?
Well, then we're toast.
What? Yeah.
Yeah, 3%. If this is steady state 3%, then the Fed probably has some room to
move.
jack up rates. And then, you're going to have a major implication on multiples, especially long duration stocks, right?
There's a question that I think is really good here that's really important. If T-bonds have protected portfolios when stocks have dropped, this may have changed. How can we design portfolios so they don't have higher built-in risk?
Oh, this is a Dave's question. Go ahead, Dave.
So, you could have an all-weather portfolio where you're not trying to make a prediction about inflation. That's definitely not us. I mean, if you buy our view, then you're in a highly asymmetric deflation risk environment. Obviously, we could be wrong. Obviously, inflation could be 5% in each of the next 5 years, but it would be a black swan if you talk to any Alpine strategist. So, of course, bonds are not going to give you a hedge. It'll be like the 1970s, and I can tell you what the hedges would be in that tips and gold and short US dollar, obviously. But if you take the view that the biggest risk for us is just like it was after 2008, which is if something goes wrong, it's going to be unexpected economic weakness and a lack of pricing power and CPI inflation below 2% 18 months from now, then it's really obvious. Those correlations haven't changed.
Right.
Government bonds are still a good hedge, and growth still outdoes value and cyclicals in a risk environment. Obviously, I'm not talking about an Alpine black swan. If we're wrong, then I can tell you what the hedges will be, but you have to assign, unless you're doing all weather, which is not taking a forecast view. It's saying I want to balance out my risks and have a little commodity exposure and a little bit of dollar exposure. But if you take into account the Alpine view, I think it's very clear. Government bonds are still an excellent hedge because yields are not too low.
And let me just push you on the growth stocks. Are you talking about the FANG stocks or are you talking about other growth stocks? Because if Apple grows 5% or 10% for the next 5 years, it's a $5 trillion company. Like, if you put the top four together, you're at $9 trillion now of market cap on a $22 trillion economy, U.S. economy. And obviously some of those are global companies, but some of them are not. Many of them aren't in China. So, when does that equation get too out of whack for you?
Let me say a word or two, Chen.
Go
I know
ahead,
you've
just
thought
say
about
2
this.
words, please.
I'll take
Please,
5
2.
words then. So I think if you take a look, there's 2 ways to look at breadth in the market, for example. There's a chart that Tony has produced with some of the other Alpine strategists, which shows that breadth is actually not bad. You look at an advanced decline line, and then there's the other chart, which I think is the key one to answer your question, which is as a percent of the S&P 500, or 6 stocks relative to the S&P 494, it's so skewed it's not even funny. I mean, it's 1/4 of the S&P 500 is 6 stocks. And so here's the way I would answer the question. I'd say it's the FANG stocks that I'm talking about as potential bubble candidates. You know, they're just fantastic overshoot mania candidates where they get extreme relative to your, you know, you're absolutely right, but they can go very, very far. And so the benchmarks, which we always write about, these bulletproof leaders, are the Nifty 50 of the early 70s, as Tony talked about this morning, and the 4 horsemen, the Intel, Cisco, Oracle, Dell of the late 90s. And these multiples have not hit those levels. So there is regulation risk. There's all kinds of things that could happen to those 6 companies, plus you're playing an overshoot. But if you just extend it a little bit further and say, if there isn't going to be a big inflation cycle and the Fed doesn't need to raise rates and interest rates eventually just settle back down to 0%, then probably the money is going to view those as extremely safe havens where the multiple can go to a level, this is where I think I get at your question, where the multiple can go to a level where it doesn't make sense and Apple becomes an X trillion-dollar company, just like happened with the Nifty 50, which are like great companies spilling off a lot of cash flow. And at that stage, I would get out of the big tech companies. Or if you have insights into how Washington decides things, good luck if you do. In terms of the risks of regulation and the risks of regulation in the next 18 or 24 months. Now, growth versus value, I think it is a little bit easier to take a longer term perspective. The multiples are quite skewed in growth versus value or cyclical versus non-cyclical stocks. And it really comes down to what you think is the interest rate cycle and whether you're really just going to kill the business cycle for a while, which seems reasonable. Jen, anything on growth value?
No. I think you've got to, it's personally, I would not put lots of money in that space because it's pretty expensive. But at the same time, I think you're absolutely right that these things can go berserk.
Yeah.
Just like longer, higher, longer, bigger. You know.
Right.
Just an anecdote. I'm not saying it's going to repeat itself, but at its peak, I think in 2000, Nortel, you know, where we live up in Canada, was 40% of the market.
I remember
just
it
one
well.
stock.
I was a telecom equipment analyst.
It becomes zero now.
Yeah, went to zero
yeah.
eventually.
And I think we have a test, you know, if there is going to be a backup in the bond market the next month or two, just very near term, and it undermines these big tech stocks and they get nailed the way the 4 horsemen got nailed regularly in the late 90s, and then it just comes right back. That will ingrain the buy the dips mentality, and that would be support for my hypothesis if it just comes back. They can correct 15%. Doesn't really change anything. It's whether the money just comes right back in as views them
And
as
the
safe
money's
havens.
been coming in, but the money's been coming in from predominantly from retail. That's been sort of the biggest needle mover versus history. And obviously 2021 has been the largest inflows into the equity market for any year already. And we're not, you know, we still have a quarter left of the year. I think 2017 was the next closest, and we've blown that away. Is that just there's no alternative, and does that scare you? Does that make you feel good? What?
I think there's data. I published that chart, actually, the retail investors' cash position.
Right,
That's
very low, right.
Very low.
And margin
around-
debt, if you look at margin options on
Yeah.
Robinhood, it's through
I
the
mean,
roof. Yeah.
to be honest, everybody, if you ask somebody, I wrote about a delivery boy who started giving me
Asking you about stocks,
give me advice which stock to buy,
That's never a good sign.
things like that, you know. That's a true story. And that guy basically quit and then, you know, burgered off and living high life. So everybody make money left and right, hand over fist. But I think this is happening at the same time that if you look at the excessive liquidity, which is basically money supply growth minus
Right.
nominal GDP growth, that's a sort of a residual usually you think about that's left over for stock market or financial markets. It's basically dropped to about zero. So, you know, you
So you
gotta,
think it dries up? I mean,
pretty
that-
much.
So
I
if
think
it dries
pretty
up and
much.
we don't get this by the dip, is
Yeah.
that,
And then
could
the
that
Fed
be a
is, the Fed
catalyst?
is going to
Right.
dial,
Yeah.
the Fed is going to dial back.
Right.
So I don't know that, that's why I don't feel really bullish now, because the Fed is dialing back the liquidity injection. The economy, I mean, yeah, the economy is doing great, tremendously well, but hey, how many people know that U.S. Personal consumption expenditure, private consumption, has been basically flat for the last 5 months? It hasn't gone anywhere. It's basically flat. That's 75% of your economy. So you gotta slow down. There's going to be, you feel like pretty hard. I mean, we're moving from annualized growth of what, 20%? Boom,
Well,
to 2,
that's-
3%.
That was sort of my introduction, is
Yeah.
sort of like, since when has good news, and this just sort of happens every time,
Hmm.
but since when has good news for the economy been good news for the market? They often don't go together. The market
Exactly.
is sort of anticipatory.
Exactly.
So everyone's saying, oh, we're going to have a boom because we just had a reopening. Well, we kind of had a boom when we were shut down. So like why?
That's exactly that.
why
You
is
know,
it-
the
right.
good news is bad news is good news.
news,
Because I'm
right.
saying is the stock market thrive when unemployment rate is highest. I mean, that's the saying. The stock market is a bad animal because the stock market thrive on people's misery. That's true. But everybody got
know
a job,
people like
then we're kiss goodbye for bull market.
Right.
That's always the case.
But Harvinder, you said, you think we're still early mid-cycle?
Yeah.
Where would you say we are?
I would say we're still early cycle
Early
in
cycle.
the business cycle.
Yes,
There's
okay.
a long way to go before we get to, you know, call it full capacity, full employment, and then usually the business cycle ends when we go beyond that, and that's when we
Right.
get the tightening of monetary policy that leads us to the downturn. So it's too early for, yes, they could remove some of the stimulus, but we're a long way from where policy needs to tighten to really slow things down.
Okay, do you think the pandemic reset the cycle? There was a question earlier, and then somebody also asked why the neutral rate would be lower post-pandemic. Do you think that, do you sort of think this is a continuation, that was sort of a non-economic blip, and we're continuing the cycle that we were in for much of the past decade, since the post-global financial crisis?
It's a bit hazy. You know, when we think back to before the pandemic struck, the Fed was actually in an easing cycle. You know, Jay Powell did his infamous moonwalk.
Well, okay, they tightened, and then they were like, oh,
Yeah,
no,
yeah. Late 2018, he's saying we're a long way from neutral.
Right.
And then in 2019, they're cutting rates.
No, sorry. Yeah.
So, you know, they were trying to extend that cycle because they hadn't reached their inflation target. Their view of maximum employment had changed. So that cycle needed to extend further before the Fed reached its objectives. The pandemic, of course, threw that off. So yes, technically it is a new cycle, but the Fed was even trying to extend the other cycle. So the Fed has been pushed back
Right.
quite significantly. And again, you have to remember that the last cycle lasted 10 years, and we didn't reach maximum employment. We didn't reach, you know, sustainable 2% inflation. We're only not even a year into this cycle. Yes, it's been compressed. It's very sharp recovery, but it's going to take a long time before we achieve the Fed's targets.
Yes, so you think, so there's still time to go?
Yes, right.
Right.
That doesn't mean, of course, that throughout the cycle there's not going to be setbacks.
Right.
You know, we had that many times in the last cycle. 2011, when the European debt crisis happened. 2014-15, when the energy collapse happened, and so forth. And obviously Powell's, you know, faux pas in 2018. We had a 20% pullback in stocks.
Yeah.
So we could get setbacks, but that doesn't mean that this long cycle can't continue.
So so what is the most important factor to look at for the markets? Is it the economic cycle? Is it liquidity? Is it interest rates? Is there, if you had, or give me your top two, if you had to
So let me get the question. So among all these factors, what are the top?
Yeah. What
are the key things?
If somebody said to you, I'm going to give you two pieces of information, and you try to predict the markets with those two pieces of information, what would they be? Yeah.
Growth, interest rates.
Okay. So I'm telling you, interest rates are going to stay low and growth is going to stay low. You think the market does fine? That's.
You mean the growth is going to decelerate?
It's going to decelerate. Yeah.
The rate, well, that's problematic because, I'm thinking of a growth
Right.
think about it as a pricing model. You got a E divided by interest rates.
Right.
In a simplified, reduced form, that's it. The E is basically determined by economic growth. If you're telling me the economy is decelerating, basically you're going to have a shrinking or a decelerating E.
Right.
Even though the rate is steady, you're going to have a problem. Of course, among these two things, the rate impact is nonlinear, right?
Right.
It's a denominator. If you shift the denominator, the things get exponential.
Right.
So, well, I think the economic growth that is basically linearly
Right.
impacting your asset prices, where interest rate is exponentially impacting your asset prices. So that's how I see it.
So last decade, China was a big contributor to global growth. There was a question about it, what's the most compelling opportunities to invest there? Well, they're asking what's the most opportunities to invest in China now, but I would also ask you sort of what do you think are going to be the big drivers of global growth? It could still be China, certainly, but probably not at the rate just from law of large numbers that it has.
I'll say a few words because my colleague Yan is in China now.
Yeah.
I don't know how the hell he managed to stay
It's
at
3
3:50 morning.
And he's
AM.
disturbingly close to that
Yeah,
bed
well,
right
I don't
now.
see his
You better get to him soon.
So anyway, I'll give you my 2 cents, and Yan, chime in at your, if you wish. I think there's a size and there's a growth. The size of that thing has become pretty big. We're talking about 16 trillion, 17 trillion. If you do 5%,
Yeah, it's a big number.
that's a big number. And also, I keep telling people, I'm not that bearish on the economic growth. I'm bearish because I don't know their policy orientation. I don't understand. But in terms of economy, it's still got about 20% of laborers are still in the countryside. Whereas the United States have 2%, Japan is 1%, Korea is about 10%.
It was 70%, so we've got, or 60%.
Exactly,
right.
we moved from 80% of
Right.
people in the farmland into 20%,
right.
and then it's still 20%
20%.
of 14,
Right.
1.4 billion.
It's a lot of
They got
people.
hundreds
Yeah.
and hundreds of million people,
Right.
still farmers that are still digging dirt. You want them to stop digging dirt and start making things,
Right.
and that basically means productivity growth.
Right.
That's what I'm saying. It's no longer as huge. Before, I'm just telling you, 90s, every year they move 25 million people out of farmland into cities.
Right.
Year in and year out, 25 million. Now we're probably down to about 4 or 5 million, but still a lot of people.
Right.
I think at this level of GDP per capita, you can sustain about 5%. I don't think you can do 7. No, forget about that. 5 is okay. 5 of 16 trillion, that's a lot of lots of billions. So I think on the growth side, I'm not quite concerned. But another thing you have to also keep in mind, economic growth does not necessarily mean translate directly into profit growth, whereas
Right.
in the United States, it does.
Right.
Everybody maximizes profits, whereas I don't know if there's a
Different.
maximizing all
Right.
kind of things.
Right.
Right? So you can have a great growth, but pretty lousy profits. It's possible.
Right.
So all I'm saying here is, Yen, help me out.
Well, also, can I put something in there? So do you think there's also been a lot of talk about, which we didn't really get into very much
Yeah.
today, but a shift towards the consumption?
My view is this. The very reason that the Chinese economy has not fallen into major crisis is because they self-finance
Right.
the industrialization.
Right.
They not only save so much, they finalize their own thing, but also left over and exported the savings. The time they become so successful to transform the economy into consumption-led, short the growth story. That's
Okay.
end of the story.
Sorry.
Finished.
Interesting.
Have you heard any country that basically party all the night, got drunk, the second day woke up, ooh,
That feels
I'm
really good.
industrialized. It's not like that. Basically, you have to accumulate, you have to save, you have to build up your capital base, increase your capital labor ratio. That is the basic economics.
Right.
I don't know, some fancy economies that just making it twisted into something that is, I don't know.
Okay,
So-
and so on that also, and we'll bring Jan in, but
Yeah.
about, what about the demographic issue in China? Is something that you
yeah.
hear a lot about. Right.
That is very true and important. I think for the next 10 years, the industrialization, the migration, labor migration will bail out that problem. Beyond next 10 years,
You have an issue, right?
we'll have a problem. Right? Because every year they still have people moving from countryside into the industrial. 2% right now account for 2% of labor force growth, migration.
Right, which, as you said, big numbers. Jan, do you have anything you want to add to this discussion?
Yeah, sure. I will say a few words, otherwise I will fall asleep. So I think actually China now is among our more favorite markets within EM. So for a couple of reasons. Reason number one is I feel investors are very bearish on China. I think, I can remember the first one of the speaker of our first session, basically kind of summarizes the views among many investors that are quite bearish on China. And if you look at fund manager surveys, their exposure to China has dropped quite a lot. So you have a very bearish consensus view on China. Number two is stock valuation, right? So China is actually now, I think Chinese stocks are trading at around 12 times forward earnings. It's near very low level, much lower than historical average. And then, I think Chinese stocks are trading at around 40% discount to global benchmark. So I think this is pretty much as low as it ever gets. And finally, China is actually the only major economy now that is thinking of policy reflation, right? So all other major economies are either tightening or are thinking of tightening, are phasing out of their QEs. So China is the only major economy that is doing a policy reflation. So this kind of policy divergence should also help Chinese stocks.
Thank you. There's a question about political risks in emerging markets, and I'm not sure if that's supposed to be specifically China or other emerging markets, but the question is, does it make sense to increase exposure here as rates back up, given the more uncertain scenario?
As an asset class, we're not super bullish on EM.
Okay.
Not only China problem. I think the Chinese problem are mostly discounted
Right.
at this price.
Well, emerging
Especially-
markets in general, the Ps are back to the
Emerging market,
90s.
no.
They're
Yeah,
pretty
the
cheap.
emerging market as a whole, if Chinese economy slows, because right now I got a bunch of problems, the coal
Gonna have-
crisis,
Ramifications,
blackouts, you're going to see the numbers are going to be pretty soft
Right.
going forward. And then you got a commodity problem immediately.
Right,
You can see copper, this
right,
came down sharply.
right.
So you put all this thing together, and then you got a Brazilian problem. You got yen help, whatever you want to say. But I think there is a political issue with Brazil. If you put all this thing together, I think probably you want to buy them a little bit cheaper
Yep.
than they are.
Okay, the next question, how do you explain the
Yeah.
fact that the dollar and oil are both going higher? Isn't that the realm of late cycle environment? Shouldn't we be worried about this?
I can say a few just quick
Please.
things. Even before this big rise in oil prices, I totally buy Adam and Lee's GRA's view on oil prices. It's really, we should have seen it coming. But even before that, energy was the only real cyclical sector that we wanted to be overweight in the last 3-6 months, the last few quarters. And it's because it's a specific story where the supply just isn't there if the economy starts to look a little bit better. the great historical environment for oil from macro perspective, as the question asks, is a weak dollar and a strong global economy. If we got both of those things in addition to the GRA story, which we totally buy, that's how oil gets to $140 or $150 again. I mean, that's a really extreme scenario. So I think the simple answer to that oil and DXY, and go ahead, Chen, as well, is that the dollar is firming up because the U.S. is looking better. Harv can talk about it. But the oil story, I think it's a specific one. Usually late cycle is the economy's been very strong for a long period of time. The Fed is tightening. Commodity prices are going up. There's a lot of pricing power. The basic industry stocks are going up. I don't think it's that kind of environment at all.
I think it's pretty simple. Totally agree with you. Oil, energy right now is a crisis everywhere. If you think about UK, got a natural gas crisis. China coal prices. I don't know, who knows? God knows. Will be some kind of a crisis anywhere. That is a very special case for fossil fuel. I think the world basically, this Biden's green stuff created huge chaos in this whole industry. And I think that has a lot to do with Biden. More I think about it, actually, Trump actually got a clearer thinking than him. But anyway, it doesn't matter. I don't want to stir any trouble here. But if you look at the dollar versus other commodities, like copper, the correlation is still very much the same as before. Dollar strengthens, copper came down.
Just a couple of comments on the dollar. We had been bearish basically since the Fed threw in the kitchen sink last March of 2020. Around June of this year, we changed our dollar view based on three factors. First, the technicals. Dollar was significantly oversold. Sentiment was universally bearish. Secondly, the Fed started to pivot in a hawkish direction, starting with the June FOMC meeting. And third, it became increasingly clear from China's credit tightening that there was downside risks to Chinese and therefore global growth. So to turn bearish again on the dollar, the technicals have certainly improved. So we've checked off one item on that list, but we still are waiting for the Fed to sort of come to our view that this inflation scare is going to fade, growth is slowing, and then the Fed makes a dovish pivot. And then, as Yan said, China is gradually moving towards more reflationary policies. So the dollar is a defensive currency. It's inversely correlated with global growth, and China is the main driver of global growth. Right. So once China begins to reflate and its economy begins to reaccelerate, that will spell trouble for the dollar. So those are the two final things we're looking for: a shift in the Fed and more reflation in China before we could get bearish on the dollar again. And then going back to what Dave said, if you get stronger global growth, a weaker dollar, and you have these supply distortions in oil prices, it could send oil prices much, much higher.
Does anybody think that the dollar status as reserve currency, basically, of the world is in jeopardy anytime soon?
No. Harv chime in. I don't think so, because the second biggest economy, which is China, the currency is not even fully convertible. How the hell are you going to be, how, I don't think. It's
way out. Okay. So let's just turn to fixed income. Is there any margin of safety left in spread-sensitive fixed income?
Okay, I'll take that one. And short answer is no. I mean, if you, so we took the Barclays investment grade index for OAS and then just adjusted it for the fact that the index, of course, is longer today than it was before, and the credit quality is lower. And making those adjustments, basically, investment grade OAS is at the lowest level it's ever been in the history of the series. And of course, you could look at these things many different ways, and their spread product is expensive. I guess the question is if you want to own it today depends on kind of the macro backdrop that you think we're in. And so we laid out a few months ago three key macro environments. So there was the overheating, then there's the Goldilocks where inflation comes off and growth is decent. And I think in that kind of a scenario, then you have more of the same, like the mania continues, the search for yield continues, spreads get a little bit tighter. I'm not sure how much tighter they can get, but the pressure is there as money keeps coming into the market, has to be put to work, and people stretch more and more for yield. I suppose they could get a little bit tighter, but a lot of things have to go right. And so over the summer, we saw that the third scenario, which is the risk scenario that Chen first laid out, where we have a bit of a growth scare in the United States, so growth comes down, no recession, but people get nervous about how low it is. China has a bit of a growth scare as well, and then add on a bit of Fed tapering at the same time. And you could just see the newspapers talking about the Fed making a policy mistake. So given where spreads were, we decided to start taking some risk off the table. We're still overweight spread product versus treasuries, but slightly. And one of our themes is to take some risk off the table in terms of avoiding those sectors that are most exposed to what I call stall speed.
Right.
So, obviously growth 2% and above, spread product does really well. If it's in a recession, spread product gets hammered. But in the 0 to 2% range, it's kind of an interesting range because some spread product does better than some spread product is much more sensitive to that than others. For example, obviously high yield corporates, even investment grade, they're much more sensitive than, say, parts of the non-agency CMBS and especially municipals. Municipals kind of stand out to me as a place where lower quality, both taxable and non-taxable, lower quality, better valuation than in corporate bonds and less sensitive to stall speed.
Right.
So, like I said, we're still a little bit slightly overweight spread product. That may change if our indicators get a little bit worse. We may actually go to neutral for a while. So this is like a tactical shift.
Okay.
But right now we're getting a little bit of spread pickup from, like I said, municipals and non-agency CMBS.
So let me play out this scenario again one more time. I'm going to try to nail everybody down on this. Okay, the scenario is growth slows in the U.S. From really rapid rates and maybe slows more than people expect. Growth might slow at the same time in China. And as you said, it might happen at the same time the Fed making more noises about not being in emergency mode anymore. So I'm going to say the market doesn't like it. So the market doesn't like this combination of things. You get the market going down. You get the Wall Street Journal headlines reading, bear market coming again. You get people nervous again. You get confidence you get this vicious cycle of confidence going down. And then the Fed comes into the rescue again, right? So the Fed has to do something. You get, and then does the market then react the same way and you get the same the same raise? Because that might be the case, but at some point, the returns have to start to slow. As you said, the equities and fixed income can't be divorced forever. And if the scenario is a Europe-like scenario or Japan-like scenario, like U.S. investors just aren't going to stand for that. They might not have my supposition is that they would rather have dips and booms rather than just nothing for decades. So somehow it's going to, if the long-term return from where we are has to be low single digits, and that's me putting that on there. And if you disagree, certainly say that. What's the trajectory on how we get to low single digit returns at 2030? Sorry, I don't know if that was even a question. But there was a lot there.
It's a good question.
Right.
Multi-million dollar worth, but hard to answer. But let me give you my shot. I think the character of Americans is boom bust.
Right. You think it's boom bust.
The character of Japanese is just monotonic.
Right. So you think so something's going to have to go bust, and
exactly.
then we can start climbing from there.
The dynamic of this market and this economy is boom bust.
Right.
I think it's going to be boom bust. Lots of people talking about this is like correction, 10% or so. More and more I think about it, probably going to be more than that, I think.
Right.
We had one hell of a big rally. I mean,
Right.
everybody becomes so much richer. It's not even funny.
Well, if
I
you
feel good,
also-
but hey,
right.
don't get me wrong, but hey, it's not funny.
Well, if you also look at it,
Yeah.
if you look at it by decade, the S&P does seem to go in a stair step from 2000 to 2010.
Yeah.
Really didn't do anything it moved because it moved down so much and then it came
Exactly,
back, but it
yeah.
sort of ended the decade. And then from 2010 to 2020, we had a great run.
Yeah.
And then, in the 90s too, you had a great run. And if you look at it, if you do a logarithmic scale, it sort of does
Two
very
sigma.
much look like a
You see Tony's chart.
Yeah. Oh.
It's a two sigma
Right.
on the top band, right?
Right.
So I would say, I mean, you usually do not get a bear market unless you have a recession.
Recession, right.
You can have more bear market than recession, but you will always have a bear market if you have
In
a
a
recession.
recession, right. Right.
So, the chances are that we're probably not going to have a recession. That's a
Right.
sort of consensus view. I'm troubled by that. On that view,
You're
we're squarely
Right.
at this consensus. Which may be right. I don't know, but I'm not comfortable.
Right.
Okay, I'm just declare that. But let's say if not, there'll be no recession, you could have a pretty sharp correction. Right now, you can see the market correcting when it starts.
Right.
The thing just going down fast
Right.
because of the long duration stuff right there. To answer the question, Amy, I think it's going to be a boom bust. I think you're going to correct that overbought condition, big decline, and then followed by
And then we'll
some
be-
kind of rally.
right.
Yeah.
Even if we don't go into a
Yeah.
recession.
Yeah. I also just remind all the listeners here about what Jim Paulson said at the outset, and he was the bull. So even in his most bullish scenario, returns over the next 4 or 5 years go down to 8%.
I'll take it. If you can
Yeah,
put
no,
that in
but
writing,
that was
I'll
his, that
sign
was
it.
his, that was his best scenario. So clearly, what we saw the
Right.
last year is
Right.
not going to continue. It has to be some type of a correction,
Percent
then more
Yeah,
modest
another
gains.
thing is like this stocks theory, right?
Mm-hmm.
So if you can look at you stack up all different asset class, you rank them up, the top performer this year
Right.
usually become bottom performer
Yeah.
next year, and then the
like
next
that.
bottom becomes top. Just oscillate. You
Right.
just close your eyes on what was the best performing market last year.
What didn't work,
S&P
exactly.
500 was the worst one. Was that? So buy this, sell that. Usually you get it right.
Right.
But hey,
Right.
but the thing here is like 2 years in a row or 3 years in a row, S&P actually is the top performer. So if you close your eye, you got it wrong.
Now, the
You lost something.
NASDAQ
Hey,
is
but
on the top.
at some point, this thing gonna get right. That's all I'm saying.
Okay, we have 12 seconds, so I'm going to ask the last two questions, and then I'll let you guys. Given your sanguine outlook on inflation, what percentage of portfolio do you think should be in commodities?
I think the forecast is very different from running a portfolio. When you run portfolio, you guys know better than me. You have to take into consideration of your risk control. You have to assign probably what if you're wrong. If I'm giving you a forecast, I'll probably have very small amount in commodity because I don't believe inflation. I think inflation is going to fall faster. I think the Chinese economy is probably going to run into some kind of a problem. So I don't want to have that. But if you run a portfolio, you have to basically take into consideration that you could be wrong. So I think you probably personally, I think I'm strongly advocating for this portfolio for a long time. A third in high quality growth, a third in value, and a third in defensive. Period. Simple.
Well, to your theory that what didn't work recently will work, I think, and Zach might remember the numbers. I'm not sure I remember them off the top of my head, but since the global financial crisis, I think the energy sector is up 32%, and the NASDAQ's up like 4,000,
Yeah, something like that,
1,400% or
yeah.
something like
Yeah.
that. There's a very big discrepancy there.
Yeah.
But, and energy is only 3% of the S&P or something like that now. I don't think I would ever have called that, but that's a PM perspective. So, and how would markets react to a change of Fed leadership? Lael Brainerd, bullish or bearish for equities?
Well, she's considered to be on the dovish end of the spectrum. So if she shifts Fed policy in that direction, get zero for longer, bond yields come down just because of what Chen said, liftoff is pushed out, the terminal rate is low, then it becomes the same thing, there's no alternative.
Right.
And valuations just get bumped higher.
Do you think Powell gets reappointed?
Well, he's still the odds-on favor, but those odds have shrunk in light of the so-called trading scandals, and apparently the latest was the vice chair traded millions of stocks the day before the Fed made its big announcement.
That's pretty bad.
I didn't hear that one.
Yeah, so if he's associated that it happened under his watch, and
Right.
Elizabeth Warren has already come out clearly against reappointment, the odds have certainly diminished.
Okay, should I wrap it up? Okay.
Wrap it up.
Thank you
Yes.
for my panelists. It was wonderful. And thank you to Alpine for a great day.
Thank you, and thanks to
Housekeeping item, we're going to have a little reception, some drinks if you wish. And also, please feel free to pick up Marco's book. It's all on the table there, desk, outside. So that's for you guys. Hope to see you at the reception.